And welcome to this month's version, the November version of Farm Office Live. This is our special tax edition of Farm Office Live for the fall, and we're certainly happy to have you all with us on this warmer November morning. We had a bit of winter there the last few days, but it seems like fall has returned. So a lot of familiar names. We're happy to see so many of you back with us. If you're new with us this month, well, welcome for the first time, and we hope that you'll join us each month. Again, this is our special tax edition. This is a course, or this is a webinar that's laid out for just the layperson. If you're a tax practitioner that's joined us today, well, welcome. However, there won't be any continuing education credits with this class today, with this webinar. We've recorded this, or we will be recording this session, and it will be posted to our Farm Office Live webpage, so you'll be able to access this and view it again if you so choose, because nothing says joy of the holiday season much more than rewatching a tax webinar. So we hope that at least if you have that interest, you'll come back to it. And Jeff has posted that on the chat, and we're going to be posting some things in the chat feature throughout the day as we encounter new materials that may need a link. We'll be posting that information in the chat. Okay, we've already got a question, and folks are already understanding what the Q&A feature is. Here's our list of topics for the day. You can access, again, that right here in the bottom right-hand corner, you can access our Farm Office Live site. Got several colleagues that are going to be joining me here, and this is our lineup for today. Now, this is not our entire Farm Office Live team, but these are the folks, those of us that are going to be doing the instruction today. Myself, Barry Ward, I'm the leader of production business management, I'm the director of our OSU income tax schools. Dave Marison, a professor and field specialist in farm management. He's also the interim director of the Farm Financial Management and Policy Center. Jeff Lewis, my colleague in OSU income tax schools, legal associate, attorney, ag and resource law program, and sharing him with Peggy and Robert in that program. And then Robert Moore, attorney, OSU ag and resource law program. We're happy to have Robert with us as well today. So that's our teaching team today. Questions, if you have questions, and we already have one already posted, we'd like you to put those in the Q&A feature. You have a couple of different ways that you can interact with us. The chat feature, if you just have a comment, that's something you can put up there. If you have a question, a subject matter question, we'd like you to put that in the Q&A feature. That's the easiest way for us to track those particular things or questions throughout the day. Okay, I'm going to launch us here in just a moment. I'm just taking a look at the chat feature. We've got folks from all over. It seems like we have someone from Baltimore, so welcome for the first time. A lot of you have weighed in and just said good morning, so good morning right back to you. Okay. We're going to start off, and I'm going to start off by talking generally about the farm economy and farm income and what we might expect in 2026, because tax planning, as all of you know on here, and we'll address this in certain areas throughout this morning's webinar, understanding your farm income and its ups and downs is an important part of tax planning. Whether or not, and most of you are cash basis taxpayers, trying to understand all the ups and downs of farm income are important because, well, we can often influence that, especially at the end of the year when we're looking at whether or not to sell grain in 25 or push that on into 26, or how many prepaid expenses we might choose to pay in 25 versus 26. So trying to understand our farm income and the farm income outlook for this next year. That's going to be also an important piece of tax planning. So we're going to just touch on this just a little bit, as at least I see it looking forward into 26. We've had some ups and downs. This is Ohio soybeans returned to land over the last roughly 20 years. And this is some significant increases and decreases in returns over this period. We had this period back from 2007 roughly to 2013 where we had elevated returns, followed by a period in there that was lower, and then followed by a higher period here recently, just during that and post-COVID period where we had higher incomes in row crop production in Ohio and most of the Midwest. And those led to what we now see as kind of some entrenched or sticky input costs that many growers across the state and many of you are having to deal with. So we're now in a period of lower margins generally in row crop production across the state and across the Midwest. So I think that's something that's not news to most of you on here. Just some challenging times that we're in right now in terms of profitability in the row crop sector. This is our outlook for this next year, our corn budget, if you will. In other words, we're looking at all the input costs and revenue potential for the 26 crop year. Still some challenges for row crops as we look forward. Is it going to be worse than last year? It's going to be much the same, at least as we see it right now with the price of corn that we can lock in for next fall delivery. So nothing exceptional here and more challenge as we see it. The same with soybeans. This price has perked up a little bit in the last couple of weeks as some of the trade issues have calmed down a little bit, especially with China. That price we're plugging in around 1080 for soybeans next fall. Profitability potentially a little bit better for soybeans versus corn, but it largely depends on your own farm and how those yields and how the yield comparisons and ratios might be for your particular farm. Looking at livestock. Now, this is a little less certain. Livestock generally, with lower crop prices across the country, lead to lower feed prices. So livestock sector has generally benefited from these lower crop prices in the last couple of years and seen some increased profitability. Likely going to see that next year. The beef sector, boy, that's been in the news a lot over the last few weeks, and still expectation for 26 is largely positive in terms of income potential for cow-calf and those people that are feeding cattle, mostly positive as well. Dairy, it's kind of a mixed bag, although in talking with some folks recently, it looks like profitability has been relatively positive in 25 and possibly on into 26, although the size of the herd often is influencing this profitability with the larger dairies, seeing some additional profitability as compared to the medium and small sized herds, just taking advantage of those economies of size and scale. Our highly integrated sectors in Ohio, the swine and poultry, relatively positive, not big profits, but the expectation is generally positive margins into 26. Poultry and eggs, of course, carrying a lot of risk. We saw a lot of avian influenza in Ohio this past year in Western Ohio. And those integrators and also those that own barns and are feeding out or raising poultry and eggs, they're carrying a larger degree of risk, probably into 26, based on past year's experience. So that's pretty much where we stand right now on the outlook for 26 in planning. One last point, and that's looking at land values in Ohio. And many of you that might be looking to sell or purchase land, it might come with some costs. Those are selling. If you're looking to sell, there's capital gains potentially involved and subsequent tax that's associated with those capital gains. We've experienced from 20 to 24 perhaps one of the strongest bull markets in farmland value, farmland market in, my lifetime. 20 to 24 in Ohio, at least our survey showed an increase in farmland value somewhere between low 40% to low 60%. tremendous growth in land values based on a number of reasons, and many of you on here know what many of those are: increased profitability, pressure from development, other things across Ohio have led to these increased land values in farmland market. So just so you're aware, and I know many of you are, if you're looking to sell, there's likely going to be some substantial capital gains that you're going to have to pay tax on. Okay, switching gears from the economy to tax, why we're here. We're going to talk, and I'm going to talk first of all about federal legislation with tax implications. And when I talk about that this year, we're talking about the One Big Beautiful Bill Act and the passage of that. And that was signed on July 4th by the president. Whether you care for it or not, this is the new law in tax. So we're going to talk about many of these provisions throughout the morning. I'm just going to talk about a few that are general tax provisions, not necessarily farm specific. But if you've been following the news or reading any articles, you're probably well aware of what these tax provisions are. Okay, so some of these are going to be in effect this year. Some are going to be in effect not until next year, and some are made permanent. Some are temporary. So there are some differences in some of these tax provisions as far as whether or not they're permanent, whether or not they will expire. Pardon me, they will expire in a number of years. The individual income tax rates that we were accustomed to under the Tax Cuts and Jobs Act, those will remain lower where they are now, and those were made permanent. The standard deduction at $15,750 per individual, or double that for those joint filers out there, that is also permanent. Personal exemption eliminated. A deduction for seniors. All right, this is one of the new ones. This is also one that's going to be somewhat controversial. All right. In spite of what the president has said recently, and in spite of some of the news articles, they did not eliminate tax on Social Security benefits and the payments. This is the placeholder for that, if you will. This is what they have done instead of that. All right. In the legislation, they included an additional deduction for seniors, those over 65 and older, I should say. And it's an additional deduction of $6,000 in addition to your standard deduction. So that is what they have done with this legislation as a way to offset some of that Social Security payments, those Social Security payments that many of you receive. All right, so just a clarification on that. This is what they have considered the placeholder or the substitute for eliminating tax on Social Security benefits, an additional deduction for seniors 65 and older. Okay, and it is temporary. This is not a permanent piece. It's only good from 25 through 28. All right. Child tax credit increased to $2,200, made permanent. Another big controversial piece in the legislation as they were debating this is the state and local tax deduction limit. All right, or in other words, known as SALT. That's what it's typically referred to in much of the discussion and many of the articles. It was increased from $10,000 to $40,000. So what this might do for those of you who have potentially high property taxes, high mortgage interest, these kinds of things, this is going to elevate that limit and allow many of you to consider itemizing your deductions once again. All right, this is also temporary from 25 through 29. An additional piece that they added are charitable donation deductions, even for those that itemize, for non-itemizers, and that's still going to include the majority of us. We'll be able to claim a charitable deduction even if we're not itemizing our deductions for $1,000 for single filers and $2,000 for joint filers, but that doesn't kick in until next year. Okay, so 26 forward. So those are a few, not all, but those are a few of the extensions, if you will, or new pieces included in the one big beautiful bill, OB3, if you will. All right, now more specific to farm businesses. There's a couple, and then I've got colleagues, David, Robert, Jeff, that are going to be touching on some of these other issues. One of the biggest pieces I felt was the extension and the permanence of the qualified business income deduction. So they extended this, they made it permanent. This is the 20% pass-through deduction. It's got a number of names. All right. Section 199A is the part of the tax code where this language resides, and just allowing you, and most farmers out there will qualify for this as a qualified trader business, this qualified business income deduction. In other words, this is going to continue. All right, a new piece, Internal Revenue Code Section 1062. I know for many of you that doesn't mean anything, but what it's allowing us to do for those that are going to be selling farmland, sellers can choose to pay tax in 4 equal installments on a given farm sale. So you're going to claim the income when you sell the farm, but instead of paying all the tax in the year of sale, you're going to be able to pay that tax in 4 equal installments. So that will spread out that tax over those 4 years, make it a little less impactful in the year of sale, perhaps, for those that are going to be selling farmland. Now, part of the problem is, and then one of our instructors brought this up to me a couple of days ago in one of our tax schools, is just make sure that the seller is not going to forget this, and they're going to have enough potential money in escrow to pay that tax in those following years. All right, so those are a couple of things that I wanted to highlight. One new thing there as far as that gain from the sale, or I'm sorry, the tax from the sale of that farmland can be paid in 4 equal installments. New piece of legislation, that's new. The other one is the qualified business income deduction. That is an extension, and we now have a permanent provision there. Also, there's an additional piece in that qualified business income deduction. There's a minimum $400 deduction that's guaranteed for anybody with qualified business income over $1,000. So there is that additional part of the QBI deduction that you should be aware of. All right, some big pieces coming up, and these are important provisions for many of you out there that have farms. Bonus depreciation, Section 179 expensing, 1099 changes, the estate and gift tax exemption change. So that is where we're headed next here in just a moment. One other new part, all right, this is, I think, the last one that I've got, is that certain development, certain buildings, certain new buildings are possibly going to qualify, or are going to qualify, for bonus depreciation. Bonus depreciation, which David will describe in more detail here in a moment. Some of this property, that what they're calling qualified production property, is not necessarily farm related, but it's farm adjacent, if you will. And here's a list of the kinds of building structures that will qualify for this 100% bonus depreciation. In the past, these kinds of structures, as they were built, were considered for tax purposes 39-year property. So in other words, they were supposed to go through a depreciation schedule that would draw them out and would be able to only depreciate those over a 39-year period. So these are kinds of facilities that some of you, or some of your neighbors, families, friends, you may be building in the near future. This new legislation, OB3, will allow for bonus depreciation on this kind of property. All right. With that, I'm going to turn it over to David, and he's going to take you through a good set of information next. All right. It's all yours.
Good, Barry. I want to make sure you can see the screen that says depreciation. All right, we're good to go. Well, great to see so many people on today's webinar. What a fantastic turnout that we have here today. So as Barry mentioned, I'm going to talk a little bit about depreciation, some of the things that were altered in OB3 with depreciation. But first, I thought it would be good to maybe go back a little bit and give a primer before we move into those changes, and just some background on depreciation, especially for those folks that are just learning about farm taxes that might be on here today. Since January 1st of 1987, taxpayers have been using the depreciation system that was a result of the Tax Reform Act of 1986, so many, many years ago. And this system, with a modified accelerated cost recovery system, is what we use traditionally for farm assets that are being depreciated. Specifically, two different systems: the general depreciation system, which you can see there's three different methods there, as well as the ADS, the alternative depreciation system. Essentially, however, they are all recapturing the cost of that equipment that we might have. So here's just an example of a $50,000 piece of equipment. So maybe I bought a tractor, a $50,000 tractor. Under Makers 150, you can see that in the first column. Makers 200% declining balance, you can see in the second column, and then the straight line, which is essentially the same amount each year, spread over those years. So same piece of equipment, depending on the schedule that they're on, Makers 150, Makers 200%, or straight line, we're essentially recapturing the cost, the $50,000 cost over that time. However, as you will see in the second column, the Makers 200%, more of that depreciation is captured on our tax form at the front side or the beginning of the life of that asset. So more information I want to put here as far as where can I go find more information about depreciation and all the rules. Publication 946 is your go-to publication from the IRS if you want to learn more about depreciation. Essentially, all assets are placed in an asset class. And you can see there, I've listed some of the traditional things that we might see in farm taxes under the class life. So 5-year, maybe breeding livestock or a light trailer, 7-year equipment. Most of our farm machinery and equipment, fences, grain bins would fall into that. Our 10-year property are those single purpose structures. So maybe that is a hog facility, and 15-year property or drainage tile. And then 20-year is where most of our buildings and those storage structures that we have on the farm are at. So again, if you want more information on that, you can look at that publication 946. However, besides taking the regular forms of depreciation through the Makers 150%, 200%, or the straight line, or the ADS, farmers have the option, all businesses have the option to do accelerated forms of depreciation to take it quicker. And those two methods are Section 179 expensing, and the second one is bonus depreciation, kind of what Barry just mentioned on that new bonus depreciation is there. So I want to set the stage of where we were before OB3. And for Section 179, the 2024 limits were 1.22 million, and all of these have phase out provisions when it comes to Section 179. Now, the year that we're in now with 2025, we were at 1.25 million. So I want you to remember that number, with a dollar for dollar phase out that would occur after $3.13 million. And then bonus depreciation has been, again, this is for 20-year property or less. Bonus depreciation was set to be phased out by 2027. So we were in this year, 2025, under 40%. So another 40% of the value, so 40% of that $50,000 tractor could be taken this year as accelerated depreciation under bonus depreciation. As we move to 2026, that level was to drop to 20%, and then by 2027 be completely gone. So what has happened due to OB3? So for OB3, Section 179 expensing has been made permanent, so it is permanent, with currently a max of $2.5 million worth of that accelerated depreciation. The phase out occurs dollar for dollar after $4 million. And then our bonus depreciation, additional first year depreciation, you can see that it was taken back to 100% and that was on the date that this bill was signed, January 19th. So from January 19th of this year going forward, that is now we could take 100% bonus depreciation again. There is a caveat in the legislation that you can choose to elect 40%. You don't have to take the 100%. But that is the changes to our accelerated depreciation levels. Okay, with that, we're going to move into 1099 informational returns. Again, another area that OB3 had made some alterations to. So kind of want to give, again, set the stage of where we were and why we do the things, and then show you what the changes were. So the 1099 forms are just a collection of forms used to report income. So they're information reporting forms to the IRS. And that helps for the underreporting of income that might be earned. There's 21 of those forms, 1099 forms out there. We're gonna basically look at 2 of those forms. So actually, we're going to look at 3 of them. I forgot the 1099K, but today we'll look at the 1099 NEC. So that's the non-employee compensation. The 1099 miscellaneous for miscellaneous income. So that would be like our farm rents. And then 1099K, and that is our income from third-party vendors. So you'll see the current levels that are there right now. Of course, I have an asterisk because there are some small differences there based on what is actually being. I'm trying to think of the word. What is actually being put into place by the IRS. So we'll go into the 1099 NEC. So the NEC and the miscellaneous for years were together, and they split them off a few years ago, but the 1099 NEC is for the non-employee compensation. So if you pay someone $600 or more for a service provider, then you would be required to issue a 1099 NEC to the person that provided that service, as well as a form to the IRS. There's been a lot of scrutiny been given over, and I forgot to flip that one. There's been a lot of scrutiny over the difference between an employee and independent contractor, and in previous Farm Office Lives, we've talked about this, but essentially, an employee, there's higher obligations as far as the employer if they have an employee, as far as payroll taxes and Social Security taxes, Medicare taxes. So there might be a preference to pay workers as an independent contractor because that puts the onus on paying the taxes back to that person. So there's been some scrutiny over, is this person actually an employee or is this an independent contractor? So we would advise to all of us as we hire employees or independent contractors to know how they are to be classified. So there is guidance given by the IRS on how do you actually determine whether the independent contractor or employee. It comes down to behavior control, financial control, and the relationship of the parties. There's a great publication out from the IRS, publication 779. And you can see the link there in the slides. They should be hyperlinks so that you could access that document if you need to. And then the 1099 miscellaneous. So this is the form that most of us are familiar with because this is the form that we would give to a landlord when we're renting property off of those for $600 our land rents or more. So that would be box 1. There's other things, of course, on the 1099 miscellaneous, such as a royalty income from oil and gas, especially on the eastern part of the state. If there's more than $10, it would be reported on box 2. Crop insurance proceeds of $600 or more would be in box 9. So that's basically the 1099 miscellaneous. So what did OB3 do to the form 1099 miscellaneous and form 1099 NEC? Well, currently here in 2025, the reporting thresholds for both of those is still $600. So I want to emphasize that clearly up front. The reporting is still $600 for 2025. But as we move forward to 2026, that is going to move up to $2,000 for each instance there. I think that's a great thing as far as labor and rents as they keep going up, but it's going to move up to $2,000 in 2026. And on the backside, those will be indexed for inflation. And then just a few reminders that I'd like to put in the notes, just as a reminder. I know sometimes it's tough to get those 1099s issued, but to be really on top of that, they need to be sent to the recipient for the 1099 miscellaneous or the NEC, need to be to the recipient by January 31st. And that NEC form needs to be the IRS by January 31st. Now on the 1099 miscellaneous, those are due a little later to the IRS, depending whether you're going to do that through electronic methods or through paper methods. If you do it electronically, of course, it will be a little later, March 31st. No, for the non-reporting of 1099, there there are penalties if you do not report the income. And there can be, and you'll see on the screen there, it's up to $330 for intentional disregard. They can double that. And just a reminder, if you're doing more than 10 information returns or greater, you have to submit those electronically. And the last thing is 1099K, our third-party vendors as far as settlement organizations. I think most of us would maybe know Venmo, though my kids will say that I'm being moved into the new age, kicking and screaming. I hate using electronic platforms, but it's a commonplace across the board. So there's been a lot of discussion as far as 1099Ks about what should the reporting threshold be. Under the American Rescue Act of 2021, actually that threshold was supposed to move back to $600. You notice that on a slide that I had earlier, that the reporting threshold was $600. Well, there's been a lot of discussion about this. IRS kept delaying its enforcement. Several times they've delayed it. And you can see on the screen that it was 20,000 in 2023, moved down to 2024 at 5,000. For 2025, kind of what the enforcement level was going to be was $5,000. Now, what did the OB3 do? It returned the reporting threshold to $20,000 with greater of 200 transactions. Know that this change is retroactive back to 2022. So that 20,000 level, when you see the 2024 levels, 2025 levels, the discussion that has been out there as far as the $600 limit, all that is wiped off. It goes back to the $20,000. So that's the 1099K reporting requirements. And the last thing I want to talk about as a collective group here is low income and drought years. We understand as we look at 2025 as it comes to close, there's a lot of angst as we move forward, especially some of the things that Barry showed there at the beginning about where we are heading as when it comes to net farm income. Well, net farm income has been relatively strong in 2025, mainly because we have to roll back to earlier this year when the ECAP payments were funded by the government, and that has helped buoy the net farm income for 2025 for agriculture. However, I think we're all smart enough to know that 2026 is going to be a little tighter year. So as we think about these years where low income, here in the state of Ohio, we've had back-to-back drought years, which has impacted many operations across the state. So just some reminders that our farm office team have pulled together that I'm here to share as far as just thinking about, okay, low income years, looks like 2026 is going to be tight. There's uncertainty with tariffs and trades and policy and all those kind of things. Just what some general things to think about. Well, just some thoughts that we put there on the screen. The importance of record keeping, knowing your numbers, knowing your costs of production, looking at your numbers. I'm comparing those against the corn, soybean, wheat, and maybe the cattle budgets that Ohio State's putting out, comparing the two and benchmarking yourself against those budgets. Budgets maybe not only from Ohio State, or whether that's our friends at Iowa State, Penn State, Michigan State, wherever it may be, that are we benchmarking ourselves to look at the cost of production, and are there areas within our production system that we can tighten the proverbial belt? And of course, update the balance sheet. Where's the working capital? How's cash flow going to look like as we move into the new year? Is there going to be a need for emergency loans? Managing those costs. Are there things within our production system that we might just forego, cutting out those extras? There is the ability, if you receive crop insurance proceeds here in 2025 for maybe some disaster payments, there is ways that you're able to defer the recognition of that income to the next year, and I'll talk about that here in a couple slides. I know for our cattle producers, continue to look at hay exchanges and pricing those forages to purchase, or maybe it's looking at alternative feed sources. Now, the last couple of years, I've talked a lot about USDA Farm Service Agency assistance. So glad that the government shutdown is now over and they're back to work. So you'll be able to check into these programs. A year ago, we were talking about the whole suite of programs that the FSA has when it comes to disaster relief. The one that I really wanted to point out to you is the Livestock Forage Disaster Program. So this is for livestock producers who might have suffered grazing losses this past year. Now in 2024, there were a lot of counties that were covered in this. Right now, we have 9 counties in the state that there is assistance available through the Livestock Forage Disaster Program. And I want to share those with you. So if you're a producer from one of these counties, maybe a chance to walk into the FSA office to talk about that program. That's our producers in Belmont, Carroll, Columbiana, Hancock, Henry, Jefferson, Monroe, Putnam, and Wood. So 9 counties that you might want to check out. Sorry, I didn't even have those programs up there on my screen, but there they are. So those give you just a chance to look at that. I'm trying to flip screens. I'm looking forward and didn't even see that I didn't forward that. But that Livestock Forage Disaster Program for those 9 counties, again, item number 6 there. But maybe I don't know what program I might be eligible for outside of stopping in and talking to Farm Service Agency. Just wanted to let you know that they have a really cool discovery tool on the Farm Service Agency office website. You can go on to, you can actually put the county that you live in, you put the commodities that you raise, and then it will kick up the programs. So those 9 programs that you see there, it will kick the programs up onto your screen that you might be eligible for and that you might want to stop into the Farm Service Agency to talk to more about those programs. So just a great way to do that. I mentioned crop insurance deferral. IRC, the Internal Revenue Code 451F allows a 1-year deferral for crop insurance received. So this is for the damage. This is like, I know most of us are, as producers, might have a revenue-based insurance program. It's not for the revenue or the price side. This is for the production side, the loss side. If you, under normal business practices, might harvest your crops, say in 2025, but really you don't market those to 2026, but maybe you had a disaster claim, an insurance claim this year that you've already received the money. If you receive the money and you normally market that crop in the next year, the 451F insurance adjustment allows you to push the recognition of that insurance payment to the next year. So again, if you're a farmer on today's call, this might be something to talk to your tax accountant about. And that, of course, we would say go right to Pub 225, the Farmer's Tax Guide. They have more information. There's some examples, which I don't have time today to talk about. But essentially, what it's showing you is anything that was can be deferred that is a production loss, not a price loss if you have a revenue-based policy, but it's, again, a production loss, not the price loss. And there's a couple examples that are there in the Farmer's Tax Guide. You can access that. Well, I don't believe our 225 publications are out in our local extension offices yet. However, you can just go right online to pull up the Farmer's Tax Guide for more information on that. Also on the other side of 451G, again, this is if you're a cash taxpayer, it applies to our livestock side. So it's a 451 again, but it's G. And that is for if you were in a weather declared federal assistance program, so probably would tie up to those 9 counties that we mentioned. Again, you can defer some of the election of that that receival of the money from the livestock sales. And then there's also another thing that you might want to talk to your accountant, your professional with, and this is the involuntary conversion reinvestment rules under IRC 1033. So this is for our dairy breeding or draft animals. So this could be because sales due to drought, highlighted drought there for you, flood or other weather conditions. Some states have had both, right? So this is saying that I have had to sell these dairy or breeding animals, which is not normal, part of my normal business practice. So this exclusion allows you to replace, gives you a time period to exclude, must replace. So basically you're not reporting that income because you're giving yourself 2 years from the sale to be able to replace those animals, that replacement property of the same kind that you plan on replacing those. So again, it's just something to talk to your tax professionals about. That extends to 4 years if your area is eligible for some type of drought or federal assistance. So this assistance is reported every September, and I wanted to show you, and hopefully your screen's big enough to show this. Last year we had 40 Ohio counties that were eligible for this, the 4 year, 40 counties on that list. Now, if you're really quick in going through and adding these up, there's actually 80 counties, 80 out of the 88 counties in the state of Ohio that were just on notice 2025-520 or 52, which was just released in September. So again, if I'm a cattle producer and I've had to sell some of that breeding livestock that I was holding because of these drought conditions, you might want to have this conversation with your tax professional, maybe how you could utilize this program. So with that, I'm going to turn it over, I believe, to Robert Moore. And Robert, it's all yours.
All right. Thanks, David. Okay, so I'm going to focus more on tax issues with estates and estate planning. And the first thing we're going to get to is the all-important estate tax exemption. Many of you probably already know much of this, but I think it's good to review, and maybe a few of you that haven't worked with estate taxes may not be familiar with this. But in Ohio, we're fortunate not to have estate taxes. Those were abolished by the state legislature in 2013. But if you are with us from somewhere other than Ohio, there are around 18 states or so that still have some type of estate or inheritance tax. So again, if you're not in Ohio, you might want to check, see what the status of your state is. We do have federal estate taxes, but those have steadily increased over the years. And one of the irritants in life is every 4 years, when our presidential candidates are roaming across Iowa trying to get votes, it seems like invariably the issue of estate taxes and how we're losing all these farms to estate taxes comes up. Well, according to the USDA, estate taxes are not an issue for the overwhelming vast majority of farms. According to the USDA, only about 2/10, that's not 2%, that's 2/10 to 3/10 of farm estates pay estate taxes. So with today's estate tax laws, very few farms have to worry about estate taxes. Here's just a historical rundown of where estate taxes have gone. Back when I first started practicing, estate taxes were a big issue, and that was the first question we asked. And usually on most of our plans, we planned around estate taxes because the exemption was so low. But starting in 2010, we went to 5 million. And then since then, it's doubled again in 2017. And then the legislation this summer made the exemption permanent at 15 million. Now, I have permanent in quotation marks because it is permanent until Congress changes it. It was before the legislation, the exemption was set to expire at the end of 2026. So it did make it permanent in that it's not going to automatically expire. But we need to understand in as soon as 3 years, Congress could change the estate tax exemption. Not saying they will, I'm just saying it could. All right. So we've got starting next year, $15 million estate tax exemption for every person. We also need to keep in mind that we can double that for married people. So for most married people, they have a $30 million exemption. Now, again, back when I first started practicing, we had to, as best we could, try to make sure each spouse owned an equal amount of assets because that helped with estate tax, limiting estate tax liability. But since then, the IRS allows us to port unused portions of a deceased spouse's exemption over to the surviving spouse. So for example, let's say the exemption's 15 million and the deceased spouse is worth 5 million. So we use their 5 million, don't pay any estate taxes, but we've got 10 million unused. We can transfer that over to the surviving spouse. So the surviving spouse will get their exemption when they die, whatever that is, plus the 10 million that their deceased spouse did not use. So this is a really valuable tool. It's also nice because we don't have to worry about transferring assets around and balancing out. It's basically the spouses have $30 million exemption regardless of who uses it. Now, to get the portability, we do have to file an estate tax return. That is an absolute must. The only way you get portability is to file the estate tax return. And again, this is kind of an informational return because there's no tax due. It's just saying, here's how much this person used, and here's how much we're porting over to the exemption. Now, an important analysis to do on this is, should we leave the assets in the deceased spouse's trust and freeze those values there, or should we port those assets over to the surviving spouse? Now, why would we do that? Because we'll get a second stepped up tax basis at the deceased spouse's death. And it's an important analysis because you don't know for sure what's the right answer. In some cases, maybe where we've got assets that are going to be highly appreciating, or we're very close to the estate tax exemption, we want to leave those assets frozen in the deceased spouse's trust to make sure that we don't port them over and the surviving spouse exceeds the estate tax exemption. If we're comfortably under the estate tax exemption, we'll probably want to transfer those assets over to the surviving spouse, get a second stepped up tax basis. So when we're looking at estates, just keep that in mind. Work with your tax advisor, or if you are the tax advisor, work with your clients, explain the pros and cons of both of those strategies and see which works best. Appraisals are critical. I'll talk a little bit more about appraisals later, but critical to establishing that stepped up tax basis. Okay, let's move on to sale of inherited assets. So When I have worked with families that have a loved one die in the past, we meet and start going over the estate administration, and it's not the most fun meetings to have. People are, missing their family member. But one thing that I usually could say that would put smiles on faces is when we started talking about a stepped up tax basis. A lot of people aren't familiar with this, but when I would tell the heirs, you just inherited $500,000 of equipment, you were under the estate tax exemption, so no estate taxes are owed, but we get a stepped up tax basis on all that equipment. So you can redepreciate it or you can sell it. And if there's no gain on it, you pay zero tax. So a lot of people are surprised to find out the value of this stepped up tax basis. It is an enormous benefit to beneficiaries and heirs. So how do we get the stepped up tax basis? Typically, it's the appraisal value that's done by the estate. But if the asset is sold shortly after death, 6 months or so usually, and it's at arm's length, not at a discount to a family member, but if it's at arm's length, we can use that sale value as well. But again, inherited assets can be sold for little or no gain due to that stepped up tax basis. Also can be depreciated if it's a depreciable property. So what about capital losses? We know that we may not have gains due to the stepped up basis, but can we capture a capital loss? Yes, we can, depending on how that asset is used. And maybe I got this in the wrong order. Let's start out, when can you not take a capital loss? If you inherit the asset and then you use it for personal use, you generally cannot take a loss on that. But if you use it for a trade or business, or you don't use it for personal use and your goal is just to sell it, then you can take a loss. So it's really about, if you can just avoid using it for personal use, you can likely take a capital loss. So let's take a look at an example. If somebody inherited a trailer from her father, she used it to transport her toys and snowmobiles and ATVs, and then sold it for a loss. Well, she used it as for a personal use, not for business. So she would likely not be able to capture that capital loss. But if she inherited the trailer and then attempted to sell it, or did sell it at a loss, but never used it for personal use, the IRS would say, well, you attempted to make a profit on it by selling it. You ended up taking a loss on it, so you can take that capital loss. So if you inherit assets and you may want to take a loss on it, just be sure not to use it for personal use. We also need to keep in mind that assets can switch classes from when the person owns it to when they die, and then it's owned by the estate or a beneficiary. And grain is a good example of this. If you're a farmer and you're selling grain, you obviously pay ordinary income tax on that. But when the farmer dies and then that grain is inherited, it is now a capital asset. And again, it also gets a stepped up tax basis. So as long as the person who owned the grain was a farmer, was actively engaged, material participation, that grain will get a stepped up tax basis. And a lot of people are surprised to find that out, that all that grain can be sold. And if it's sold for at or under the market value at date of death, no tax on the sale of that grain. So huge benefit. Okay, let's go to valuation of unharvested crops. So this is a common situation we get into where we'll have a farmer die middle of the summer and we've got crops in the field. So then we go through the process of determining, well, what's the net worth of the farmer? We've got crops in the field. We got to put a value on that crop. How do we do it? Well, all estate assets are required to be value at fair market value. And fair market value, IRS defines that as generally price at which property would be exchanged between a buyer and a seller, arm's length transaction. So that's all fine and good. That works well for grain. It can work well for machinery. But how often is a growing crop bought and sold? As far as I know, that's really rare. So we really don't have a market for growing crops. And so I think unharvested growing crops are the hardest assets typically to value in a farm estate. So can we get an appraisal on it? Well, that would be the ideal scenario. Call up an appraiser. Hey, I've got 500 acres of corn. Can you put a value on it? That would be great. I'm just not sure how many appraisers are willing to do that. Licensed appraisers have responsibility and liability for their appraisals, for the values they put on those appraisers. And I'm just not sure how many appraisers are trained or have the experience or want to put a value on crops. So if you can find an appraiser to go out, put a value on your crops as of July 4th, that's great. But there's a chance you're not going to be able to find an appraiser to do that. So if we can't get an appraisal, what do we do? So I want to be clear here that as far as I know, the IRS doesn't have any specific guidelines or guidance that says, here's how you value unharvested crops. So what I'm going to give you is some ideas, suggestions, but just be clear, the IRS has not said this is the way to do it. Just some ideas. Okay. So if we can't get a value through appraisal, I think the next best option is to use Barry's enterprise budgets and custom rate survey. That's good data you can use. And then we calculate the value of the unharvested crop the best you can. And my guidance here is be reasonable. Don't get greedy and try to make it way high or way low. If you're reasonable about it, you'll probably be fine. I would also say, when we're finding out what the fair market value is, fair market value is what it is. We shouldn't be trying to manipulate it higher or lower. But I will have people say to me, well, don't I want to make the crops low to avoid estate taxes? That's a very common mentality. But let's go back to the slide. How many farms actually have estate taxes? 0.2%. So most likely we don't have an estate tax issue. So we don't want to make the crop values low because we want a higher stepped up tax basis to save on the taxes when the grain is sold. So don't be anxious to make the value low. Let's make the value at fair market value and capture that stepped up tax basis. So when I would deal with this issue, my first question is, where were we in the crop season? If it was May 1st and the crops just got put in the ground and then the farmer died, I'm probably going to value that crop at something pretty close to the input cost and the cost of the operations to get in the ground. So if the farmer or the estate is able to provide, here's how many pounds of fertilizer, here's our seed cost, here's our machinery cost, we can use the actual cost for that they have. Now, if they're not able to provide you a specific cost, because they just didn't break them out or for whatever reason, then I think you can go to the enterprise budgets and the custom rate survey. How much does a typical acre of corn cost for fertilizer, seed, machinery, all of that? Just use that number. Now, I think you can bump that number up a bit because once the seed is in the ground, we've eliminated some risk of not having a crop at all. Maybe if the seed is emerged, you bump it up a little bit. I don't know how much that should be. Again, just be reasonable about it. But generally, for recently planted crops, I will just use what did it cost to get it in the ground, and then maybe bump it up just a little bit. So I think the hardest one is the knee-high 4th of July corn, because it's mid-season. What do we do here? And the way I would approach it, again, this is just my ideas, is I would say, well, what did it cost to put in the ground? Ultimately, what was the crop worth? Because again, we're evaluating this after death. The crop's been harvested, but we have to go back to date of death and put a value on it. So what I would usually do is say, okay, how much did it cost to put in the ground? Ultimately, what was the crop worth? How far were we through the crop season? And then use that formula of if we were 60% through, I'd take the 60% of the difference between the two, add it to the cost to the ground, and that's where I would come up with this. So if we had $500 an acre input cost, the crop was ultimately worth $1,000 an acre. We're 60% through the growing season. I'd come out with somewhere around 800 acres. Now you can punch all kinds of holes in this, and it certainly isn't perfect. But again, I think as long as we're reasonable, we'll be just fine with the IRS looking at this. All right, what do we do about mature crops? Typically, this is pretty easy. We just see what yield, what was the price, put a value on the bushels, and then we deduct what it costs to get it out of the field. So harvest, transport, drying, marketing. So I think this is pretty logical way to do it. And again, if you don't know what your harvest costs are and hauling costs are, just pull up Barry's custom rate survey. Has all those numbers in there, very easy to use and easy to document if you would have an audit. Okay, so that's grain. Timber, sometimes we'll value that for an estate as well. Timber is easier, well, at least from the administration point of view, it's easier to value because there are professional foresters out there, consultants that you can hire, and they'll come in and survey and look at this acre, put a value on it, extrapolate it out. So if you do need to get your timber valued, just contact a professional forester, and they can do that for you, and they do it all the time and very good at it. So timber is not nearly as hard, in my opinion, to value as our standing crops. Okay, let's keep moving. Special use valuation. This is section 2032A of the IRS code. What this code allows us to do is, it doesn't only apply to farmers, but I would suspect farmers probably use it the most. But this provision allows us to value farm real estate at farm value rather than fair market value. So if we've got a farm estate that's over the estate tax exemption, we can apply 2032A and reduce that estate by up to 1.4 million. There is a cap on it, but farmers get an extra, most farmers get an extra 1.5 million exemption from their estate taxes. So farmers really have $16.4 million exemption rather than the 15. So how do we use this, or who qualifies? So you got to be a U.S. citizen. You have to elect on the estate tax return. So it's a form on the estate tax return and where you go through all the calculations. And then if multiple people own the real estate, everyone has to agree to elect 2032A. And then the property must be qualified real property. This is the most difficult one, so let's take a look at that. Qualified real property means that the gross estate of the decedent must be comprised of at least 50% farm property. So that would be real estate plus grain, plus machinery, plus livestock, plus whatever other farm assets you have. So it's 50% total farm assets, and then 25% must be farm real estate. So maybe somebody who was worth $50 million and they just kind of farmed on the side, and maybe their farm was only worth $5 million, they would not qualify for special use valuation. So it's really meant for full-time farmers that their primary source of wealth are their farm assets. And then it must have been farmed 5 of the 8 years prior to death and must be passed to a qualified heir. It has to stay in the family. Then once 2032A is elected, you say, okay, well, we're going to take the $1.4 million deduction. Then it must be kept in the family. It must be farmed for 10 years. And the way the IRS keeps track of this is you file a lien, and the lien is to the IRS. And what that does is if you try to transfer that land, then somebody's going to see that lien that's recorded with the county recorder, and, you know, we got to address that issue. Either the IRS gets paid back, or we have to show it's being transferred to another family member. So that's how the IRS keeps track of that. So the farm does have to be farmed by a family member, but the farm could be owned by one family member and cash leased to another family member. That's okay. But a family member that leases the land to a non-family member probably will not qualify. Share rents may work, but the landowner needs to materially participate, and that needs to be real. Don't just say I'm materially participating because I had a 15-minute phone call with the tenant. It needs to be real participation. So 2032A is not the easiest program to qualify for, but for those that do, it's an extra $1.4 million deduction. So how is the land valued? It's similar to CAUV. It's a different formula, but a similar outcome. And that is, it is the annual gross rent for the last 5 years, the average. You subtract the real estate taxes, and then you divide by the effective interest rate for all new federal land loans. That's the IRS publishes that. So an example here, if we have 225 an acre rent, we deduct 50 acres of real estate. The current rate is 5.78. The value is going to be $3,000 an acre. So you can see the discount is significant. So it's a real value to minimize to estates, to minimize estate taxes. Then we don't want to put we don't want to elect 2032A on any more acres than we have to. So here we'd have to elect on at least 469 acres to get that discount. But the reason we don't want to elect on all acres is because we've got that IRS lien out there. So we don't want that IRS lien on all of our acres, only as few acres as we need to. Jointly owned land, You can elect 2032A on, but you do need to get permission from the other owners. Okay, that's my presentation. And I will turn it over to Jeff.
Thank you. Let me just get my share screen here.
And Robert, you have like 4 questions in the
Oh.
Q&A that you could answer now or later.
Nope,
Via
let's
type
do
them
that
in.
while Jeff's getting set up. Okay, are there complexities with inherited assets if parties are in different states? Not overly so, because we don't have estate taxes in Ohio. If you have inheritance taxes in your state, I don't know how that works. So that would be my only concern. If you have inheritance taxes, do you pay the assets when you receive? I don't know, because not been there. But generally, I would say there's minimal complexities. When valuing farmland, does the IRS require an appraisal, or can real estate professional provide a comparative market analysis? I'm not sure what you mean by a market analysis. I like to have appraisals done by licensed appraisers. It costs more, it may take longer, but you're much less likely to get scrutiny from the IRS if that appraisal is done by a licensed appraiser. And then also, if there is an audit, your licensed appraiser can defend that number. So I like using licensed appraisers. If a future sales contract identifies a particular crop, does that contract price influence reported? Yeah, I think you would use the contract value times yield to come up with the gross value of the crop. So yeah, I think we ought to be using the contract value, not the cash price value as of date of death. And let's see, could you use your crop insurance guarantee as a value? Could you use your crop insurance guarantee? I'm going to say no to that, because I think, are you saying you're guaranteed a certain gross revenue from that? That's a good question. I don't know if there's any IRS guidance on that. It's the value of the asset that would change hands between buyer and seller. I'm more inclined to think we would take the value of the crop. The estate may get a crop insurance payment. That would be an additional asset to the estate. So I think I would value the crop at fair market value, and then any crop insurance proceeds I would treat as a separate asset to the yeah, that's how I would do it. And then we get a stepped up basis on the crop, and then you'd likely report the insurance as ordinary income. That's how I would do it. So, okay. Thank you for the questions. And Jeff, I'll hand it off.
All right, thank you. All right, good morning. I am here to talk about income reporting for 4-H and FFA projects. We have a brief Corporate Transparency Act update. And then I'm going to get into the hot topic of research and development tax credits for farmers. So 4-H Club and FFA projects, why does it matter in terms of taxes? Well, when you sell your project, you get cash from buyers, and that is reportable income. So the IRS defines gross income as all income from whatever source derived. So generally, everything is taxable unless it is specifically exempted by law. Unfortunately, we do not have a special exemption for payments received for 4-H and FFA projects at this time. So that is reportable income. And when I think of the income from 4-H and FFA projects, I generally have these 5 questions. And the first question is this a hobby for learning, or are the 4-H members or FFA members in a real business to make money? Then that leads into, does self-employment tax apply? Then if that is true, is it considered earned income or unearned income? Because that leads to the next one, does the kiddie tax apply? And then finally, the last question I would ask are, what are the 1099 requirements for fair boards or the payer to report the amount paid to the 4-H member or FFA member? So if the project is for learning and done for educational purposes and according to 4-H and FFA project guidelines, you would report that net income, so the money you received for that project minus any expenses. This is one of the few times that the IRS does allow for deducting the expenses from the income. You would report that on Schedule 1, line 8Z. So make sure you include the proof of the expenses for that project. And the good news is, no self-employment tax applies. It's kind of like a school project. It's not a job. So that's a theory behind it. If the 4-H member or FFA member is in a real business, and I use this example in all the tax schools, my fraternity brothers, I would argue, might have been in the business of selling livestock and showing livestock across the country and the state. They would spend obscene amounts of money on heifers or steers or whatnot and take them across the country and do their shows. And so you could argue that that is a business. And then I do know that some parents will just report the sale of their kid's project on their Schedule F. And so if the project is regular and for profit, you report that on Schedule F. But the bad news is that net income will be subject to self-employment taxes. Then the IRS will go through different factors, which I show you on this next slide. But the IRS goes through and looks at, is this project, is there a profit motive and it's not just for fun or just for education? Is it regular and ongoing? Then it's probably a business and not an educational project. I found this little quote. I thought it was pretty cool. Simon says, if it's once a year fun, probably not a business. So that's the way you would go through that. So in summary, I would say that most of your 4-H and FFA projects are going to be completed for educational purposes. So no self-employment tax. A few tips: keep the records of those project expenses and attach a statement of the gross income and the expenses with your tax return. That gets into the standard deduction for dependents. So most 4-H and FFA members are dependents of their parents for income tax purposes, and there is a limited deduction that dependents can take, and that is at $1,350 or their earned income, which we will get into in the next slide, plus $450. That deduction cannot exceed the basic standard deduction of their filing status. So if they probably are a single filer, the max deduction that those dependents can get is at $15,750 for 2025. So what counts as earned income? That's the next question, right? Typically, you will see this as wages, salaries, any amounts received basically for work actually performed. Again, if it is educational, it's probably not earned income. It's more like a gift. And if it's part of a trade or business, then you could arguably say that it is earned income. And why does that matter? Well, that's because earned income avoids the kiddie tax. So there is a percentage, that first $1,350 of a child's unearned income is taxed at the child's 10% rate. The remaining unearned income is taxed at the parent's marginal rate. But if it's earned income, you avoid that kiddie tax or that parent's marginal rate altogether. And then the hot topic, that is 4-H and FFA project reporting. 1099 requirements. As David mentioned earlier, right now the 1099 miscellaneous and 1099 NECs Anything you receive in excess of $600 should be reported on those 1099s by the payer. And that usually means the fair association or the business or nonprofits, they'll file that 1099 stating I paid $600 for this hog, whatever it might be. Again, remember that $2,000 threshold is coming in 2026. But the tax code does give an exception for spot and forward sales of agricultural commodities. Those do not have to be reported on a 1099. This means that most of our 4-H and FFA projects are not required to be reported on a 1099. Now, there is no prohibition that says you cannot report this on a 1099. And I think that many fair associations are issuing, I would say, unnecessary 1099s out of an abundance of caution. They're just trying to make sure that they're meeting all their requirements, regardless of whether the 1099 is required. Some fair associations and fair boards are not issuing 1099s at all. And you could argue that maybe they are required at some of those points. We also have been in discussions about, the premium price versus the market price, and, businesses will buy projects to promote their business for goodwill, marketing purposes. Is that really, well, and then another buyer gets the actual commodity. So those premium payments arguably are not spot sales or forward sales and are required to be reported on a 1099. Another issue that we've run into is that some fair boards and associations are splitting the payments between the premium payment and the market payment. And they're reporting them on two different boxes on the 1099. And based on my research, when that happens, you enter that as it is reported, but then you back it out and you add an explanation on your tax return why all of it should be reported as other income. So if you're preparing taxes yourself, you know what I mean. But if you have to talk to your tax preparer, make sure that that is what they're doing with the split payments on a 1099 or split reporting on a 1099. So the key takeaway is, as a taxpayer, you are legally obligated to report all income. So whether or not a 1099 is issued, you should be reporting the income, but don't forget to deduct the expenses for those projects. And then quick update on the Corporate Transparency Act. All that being said, there is no update really. Currently, all U.S. companies are exempt from beneficial ownership information reporting. We covered this multiple times in Farm Office Live about those owners of LLCs, C Corps, all that, and S Corps being required to provide essentially the information that's on your license. The Trump administration, when they came in to power, they issued an interim rule that said only foreign companies are going to be required to report the BOI. But as we look to the future, things might change back, so watch for new rules. We are expecting a final rule to be published by FinCEN hopefully soon. With the government shutdown, that might be delayed. We were anticipating before the end of the year, but it doesn't look like it might happen. We are still awaiting court rulings about the constitutionality of the Corporate Transparency Act. We had that whole fun back and forth earlier about whether the injunction, a nationwide injunction, was that legal, was that enforced, and then the Supreme Court said no, and then the BOI was back on, and then FinCEN came out with their rule. But if those court rulings come to the conclusion that the Corporate Transparency Act is unconstitutional, then we do away with the law unless the Supreme Court says otherwise. Future administration changes might actually affect the reporting requirements, so be aware of that. And then another special kink in this whole scenario is, how much authority does FinCEN actually have since the overturning of the Chevron doctrine, and what does that look like for federal agencies moving forward? So just be aware that things might change, and just to stay on top of CTA news, if you will. Okay. Now for my favorite topic of my three, the research and development tax credit under the Internal Revenue Code, Section 41. This is a tax credit that allows for farmers or anybody really to take a tax discount for researching new ideas. And we see a lot of consultants and promoters pitching this credit for run-of-the-mill farming processes. But is it real, right? Is it too good to be true? And so I'm calling some of these next examples propaganda, in my opinion, and I should preface this portion of my presentation with, I did all this research and I am approaching this from the point of view of, if you are a client of mine and you walked into my law firm and you asked me, should I take this tax credit? And I was giving you advice, this is what I would say. And I am admittedly more risk averse, and there might be more aggressive tax preparers, there might be more aggressive attorneys that could argue otherwise. I'm not a judge, so I don't make the final ruling, but this is my opinion, and this is what this would help me sleep at night, my opinions in this. So some of the propaganda, if you will, that we see are things that like Adams Brown here saying, here are some examples of activities that have qualified for the R&D tax credit in the past. And that first bullet point there, assessing new seed varieties, right? To me, assessing means something different than what it might mean to a lab technician or a scientist. Experimenting with new seed varieties, I think colloquially, we say experimenting to mean, oh, trying something new, which, yeah, trying something new, but is it new to the industry? Is it new to you? That's the key question. Another example, that first bullet point under the common R&D activities, improving operational efficiency through automated farm equipment. To me, that seems like it's saying if you purchase an automated planter or automated harvester and you use that on your farm, that you're engaging in research and development. And my question is, what research and development are you really doing? You're doing research and development for your own purposes, sure, but it's not a new question that you're asking. It's new to you, not new to the world, to the industry. And then lastly, another quick example, that second sentence there, your farm or ranch may qualify for the R&D tax credit if you make farm technology or operational updates, like using new or experimental soil or fertilizer, developing new pesticides, etc. Planting cover crops. Planting cover crops is not new to the industry. We know the benefits of planting cover crops, in my opinion, and yes, it might be different for you as an individual, but it's not new in the scientific or agricultural sense. So how did we get here? Why are we here? Well, that's because we don't have any guidance. We don't have any controlling authority on whether these activities that these promoters are saying constitute qualified research, whether or not those actually do qualify for the R&D tax credit. So as a good attorney does, you take what is out there, what court cases we do have, what controlling authority we do have, and we apply the principles to our specific situation, right? So the ultimate question is, do your farm experiments qualify for the R&D tax credit? And my answer, again, this is my personal answer, not for routine stuff, only for true innovation. You have to be truly innovating, I think, in the industry, not to yourself, but in the industry to qualify. So quickly, just to review, the R&D tax credit, you have to pass 4 tests. And I list those 4 tests there, the Section 174 test, the Technological Information Test, the Business Component Test, and the Process of Experimentation Test. And the first test, the Section 174, requires that there be some uncertainty concerning the development or improvement of a product or process, right? And that uncertainty must be, I keep saying industry-wide, and that's what I mean, like it's not known. The hypothesis or the premises that you are testing or wanting to test, there can be no information out there already on that desire or that hypothesis, right? So you have to show that you do not have that information that can address a capability or a method for a product or process, and that the research activities and expenditures are meant to eliminate those uncertainties. And I, excuse me, one case that really sticks out in my mind in this area, it's not agricultural specific, but it's a manufacturing plant was using a different type of machine. So they wanted to use a spray, some sort of additive that would reduce some chemical reaction or producing some chemical in their product. And this spray, this additive, had been researched in machines A and B, and we knew the results of those tests and of what that product did. And it did reduce the production of this chemical reaction. But this company had a different type of machine. They had machine C, if you will. And so the tax commissioner said, well, we know that the product does work for machines A and B, so you're not really testing any uncertainty. But the court came back and said, well, no, we have no information on whether this would affect machine C. And so therefore they were doing research and development by trying to use this product on this specific machine. But had they had a machine B or machine A, then yes, there was no uncertainty about the improvements of a product or process in that situation. So that is what has led me to my conclusions in all of this. The second test, the technological information test, it just means that the information you are trying to discover is technological in nature. This means physical or biological sciences, engineering, computer science. It does not include things like social sciences, so your consumer behavior or your market behavior. You can't be doing research on those types of things. The third test, the process of experimentation test. This means that research is qualified research under the code if substantially all of the activities constitute elements of a process of experimentation. And that substantially all threshold means that 80% or more of those activities have to be elements of a process of experimentation. So what does that mean? Process of experimentation means an evaluative process, right? So you have to prove that a process of experimentation exists. A mere statement or assertion that you engage in a process of experimentation is insufficient in IRS's eyes. And how do you prove that? Well, you have lab notebooks, journals, test results, those kinds of things to show there was a process of experimentation. And the last test is the business component test. And so research must relate to a business component of the taxpayer, which essentially is any product, process, technique, formula, or invention that you are putting out for sale, license, lease, or you're using in your trade or business. And again, that was a very brief, quick overview of the R&D tax credit. There are so many nuances and technicalities with the R&D tax credit. It's a huge chunk of the tax code. So by no means am I the expert in all of this, but in the technicalities of it all. So it is very nuanced. So in my opinion, what does qualify? And that good answer that any attorney will give is that depends. It's a very fact-specific analysis. But I think if you ask, is the product, the process, the technique new to me or new to the industry as a whole? Does information already exist that would answer my hypothesis or desire of the experimental process, right? If that information already exists, then it probably does not qualify for the R&D tax credit. So some things that I do think qualify are things like creating a new or improved crop variety through genetic selection or crossbreeding experiments that have not yet been done, right? Developing new soil amendments, organic fertilizers, or nutrient delivery systems, and the original testing of these new products. Again, not new to you, but new to the industry. Experimenting with new feed formulations or breeding techniques or animal health treatments not already used in the industry. And then the autonomous and technology, farm machinery and software, prototyping or improving that. If you're creating or refining the software, like you're adding something to the software or the sensors, or you're developing a whole new software, if you will, that would qualify for R&D tax credits. If you are creating a brand new autonomous planter or harvester, if you're improving, right, an autonomous planter or harvester, those would be research and development. Now you would have to be showing how you're improving it, but those could qualify. Things that I do not think qualify are implementing new to you, and there's a theme here, new to you planting practices that are already established. Testing brands, if you're just testing the yields of two different seed brands, then you're probably not engaged in R&D. For yourself, you are, but not in the sense of developing something truly innovative, right? If you're just using off-the-shelf technology, you're not doing any R&D. Again, these are all proven methods. There are no new discoveries. So my key takeaway for all of this, in my opinion, is if it's new to you, but known in the industry, then you probably do not qualify for the research and development tax credit. And then another theme that I saw throughout my research about these research and development tax credits, even for those arguing for or against, tracking the record keeping, tracking your expenses, your experiments, your notes, emails, all of that. And I give you a list of examples like your lab notebooks, your test results, correspondence discussing your desires, your research objectives, challenges that you have encountered, and your current progress. All of those the court was looking for to substantiate the qualified research activities and expenditures. So it's twofold, whether or not does it qualify, but also proving that it was experimentation and all that kind of stuff. So in conclusion, I do think farmers can qualify, but I don't think it's as easy as it's being promoted. Be cautious, because if and when the IRS decides to audit, there could be significant financial consequences. You'd be paying back that tax credit and possibly some penalties. And these tax credits can get into the hundreds of thousands of dollars. So that would not be good for your clients or yourself. So any questions for me as I switch over? Let me stop my share here and see if I got some questions. What are the tax consequences of an animal raised by a child and donated to 4-H? I'm assuming that at that point, there is no income for the raising of that child and then donated to 4-H. You could argue that you have a charitable deduction there for the expenses of the animal. Maybe even the fair market value of the animal included in that. So those would be the tax consequences that off the top of my head. So. All right, Barry, I think it's all up to you now.
Okay, thanks, Jeff. Really good topic, very good discussion on that. Jeff laid it out very well. And well, let's look at that a little bit closer in the future. I know we've gotten a lot of questions from both tax practitioners and also farmers and others around the state here in the last couple of years, because it's really caught in a lot of people's attention, mainly because it's a tax credit. So this is a dollar for dollar credit for any kind of tax expense that you might have. The next issue is similar, although this is a tax deduction, not a tax credit. Another issue that's a hot topic here recently in the last few years, this issue of residual fertility deduction, also known as the excess fertility deduction, and in some cases known as the legacy fertility deduction. There's a number of different names that are being used to describe this, and it's also somewhat controversial and has some of the same kinds of issues where it depends on who you listen to as to whether or not this may apply to your situation. This residual fertility deduction, it's sometimes known as the IRC Section 180 deduction, and it goes back to the 60s when and earlier, when we were granted allowances to deduct fertility applications in the year that they were applied. Okay, this excess fertility deduction is similar to the way that you might deduct expenses for purchases, farmland purchases with, for example, field tile. When you purchase or inherit a farm property, there are going to be various assets often included with that farmland. Farmland is not depreciable, not expensible. However, many of the things that come with that purchase or inheritance often are, whether it's a farm building, grain bins, field tile, as I've already mentioned. All of these different assets often accompany a farmland purchase or inheritance. So we oftentimes, as those that are buying or inheriting that property, we'd like to allocate the tax basis or certain values to those depreciable assets rather than the farmland. So that's our go-to. That's our essentially, that's what we would tend to do and tend to want to do. Now, the seller, they tend to want to allocate more of that sales price to the portion that is non-depreciable, the farmland, because that particular portion of the sale is subject to capital gains, lower tax rates. The other is oftentimes the buildings, the equipment, or the buildings, the grain bins, the field tile, that is subject to often depreciation recapture, a higher level of tax. Now, those are supposed to match, and in some cases, the IRS will look at that, but often that matching is never followed up on, never scrutinized. So we sometimes have differences in basis between the seller and the buyer. Now, this particular issue that we're looking at is very similar, and promoters out there are trying to convince all those folks, whether they be tax practitioners or the buyers of farm property, that you can allocate a certain amount of tax basis to what they're calling legacy or residual or excess fertility. Now, there's also different definitions of what that means, and also different schools of thought on what you might deduct in terms of this particular excess fertility. So it's creating lots of discussion, lots of disagreement. The promoters out there, and I've just shown a few on this slide, are continuing to be pretty aggressive in their contacts with farmers and tax practitioners. And there's different levels of risk depending on your tax filing position. The bottom line in this particular issue, is we have no real concrete guidance. No recent tax courts have made any decisions on the more aggressive positions. So it's sort of the Wild West out there in terms of what you might claim in terms of the deduction. There's a technical advice memorandum that gives us some guidance that actually was established back in 1991. The taxpayer had the soil tested to ascertain this level of its fertility, and so on. And the tax court, in this particular instance, ruled against this individual, but then they also laid out some additional guidelines that if that taxpayer wanted to be successful in this deduction, that they might include some of this additional language, and also they might conduct some additional analysis to qualify for this deduction. So this is giving us some guidance in terms of what we might do to claim this deduction. There are no cases, regulations, or revenue rulings specifically addressing the deduction for the cost of this residual fertility. So there's a lot of gray area, a lot of space. And when we have this kind of space in a particular issue, oftentimes we're going to get very aggressive promoters that will take advantage of that and promote these particular deductions for those out there that might benefit from them. And when we start to hear the idea that we might be able to claim additional deductions on our tax returns, that tends to get our attention, and it has for many out there. We have a colleague at Iowa State, Christine Tidgren. She is a foremost authority in tax. She's a tax attorney there. She's written this article that lays out basically what is actually allowed and what is framed in the legal argument. And this is as I would state it, and that's kind of the way I've been teaching this, is that this a more conservative approach, and probably the most conservative approach. What it boils down to is that if you're going to claim this deduction or attempt to claim this additional residual fertility deduction, you're going to have some proof that the prior owner had fertility applications on that farm that then you can potentially, as the buyer, claim. So proof of application goes along with this strategy, and some linkage to that former owner of that farm property to claim that, and also claim that it's above and beyond some benchmark, whether that's critical levels of soil fertility, P and K, for example, and those are the primary ones. We don't typically have any benchmark nitrogen in the soil. Micronutrients, that's an area where the promoters are being very aggressive. That probably is a step too far, because most prior owners aren't going to be making micronutrient applications. So the taxpayer must be the beneficial owner, show that the residual fertility is declining. Okay, so have some ongoing proof that we're using that residual fertility, and also attributing that to, again, the prior owner and some applications in the past. That is, as I like to put it, the conservative approach. This is the safe spot. This is an area where you, as the taxpayer and also the tax practitioner, can feel relatively comfortable in claiming this deduction. There's the moderate approach, and that's one that we've discussed also in prior Farm Office Lives, but we can look at claiming not with any evidence of prior applications, but claiming anything above a certain benchmark as excess or residual soil fertility. I've got a chart here on the lower right-hand corner. If we look at critical levels of P and K, in other words, areas where anything above those levels in the soil profile aren't going to gain us anything in terms of additional yield. If we've got excess P and K in the soil profile, one could make the argument that we may claim that as a residual deduction. Now, you're going to have, and we recommend highly, that you have a certified agronomist or a professional preparing a report for you, not only a comprehensive soil test, but also with that report indicating that how long of a period of time the P and K would be utilized, the excess portion would be utilized. So in other words, the drawdown or the period of years when we would use up that residual or excess fertility. So that's the more moderate approach. And then there is the more aggressive approach that many of the promoters out there are trying to convince folks that they are certainly qualify for, as whether they're the new purchaser or whether they inherited the property. We're going to follow the promoter's guidance. They're going to maximize those fertility deductions, and in some cases they're several $1,000s an acre. They're pretty attractive for those that are buying farmland. And they're looking at more aggressive benchmarks. In some cases, they're not looking at those critical levels as the kind of benchmark. They're looking at much lower levels of P and K. So in other words, we can claim a higher excess portion of that existing fertility in that farm. They're also promoting taking deductions based on micronutrient levels. They're not really at all looking at those prior fertility applications from the previous owner. And in some cases, they're recommending acquired pasture land, whether it's purchased or inherited. We can take a deduction on those particular acres, when in most cases, there may have been absolutely no fertility applied to pasture land by the prior owners. That's a pretty big and bold step. The one additional piece to this is that many of these promoters are claiming that with a change of accounting, those buyers or those folks inheriting farmland can go back many, many years and take this deduction on property that was purchased years ago. This is a bold claim, and we feel that this particular change of accounting method to take advantage of those prior acquisitions is very risky. And we feel that the IRS would likely disallow any kind of a claim like this. So there's a lot of things going on with this particular deduction as well. Many of you out here probably online have had experience with this or been approached by some of these individuals. The one thing also that we're finding is that these promoters are not going to be the ones that are going to be filing that return or signing that return. In most cases, they're going to provide you with all the information, and you and your tax practitioner are going to be the ones signing those tax returns. So another red flag as I see it. Okay. All right. Moving on, just real quick, it doesn't affect too many people, but those that had to exterminate birds last year based on having the avian flu, and we had some of those, especially in Western Ohio, where many birds had to be euthanized in many of those poultry barns. There was some indemnity payments that were allowed and were paid out for those birds that had to be euthanized, and we had some questions as whether or not that income from those payments was taxable. USDA APHIS, that's the agency, or that's the arm of USDA that's working with farms on depopulation and disposal. The agency coordinating the indemnity payments. There was some indication from some of these folks across Ohio that these indemnity payments were not taxable. We have been following up on this. We feel that this is an error, that the 1099-Gs have not been distributed and may not even this next year. However, this income we feel is taxable, and there is an error from APHIS in their reading of actually some language back in a previous farm bill, the 2018 farm bill, that led them to this interpretation. But if you are one of those integrators, or you maybe have one as a client, or one that has one of these poultry barns, we are indicating that this is going to be taxable income. All right, so there's some additional information on that issue. It doesn't apply to very many, but we think that this is an important issue for those that it does apply to. Lastly, my last issue is going to be talking about everyone's favorite, and that's current agricultural use value or property taxes on farmland. You know, we know that many of you out there are very aware that this is different than the way other property is valued in Ohio for property tax purposes. The CAUV program allows us to value farmland based on a formula or based on a net income method of appraisal. So it's based on a number of variables, and how these variables change throughout the years will determine what the value of farmland is going to be for property tax purposes. So this is the program, and it oftentimes values farmland well below what comparables might be if we were to use the approach that we use for residential property and other properties in Ohio. So variables and I want to thank Farm Bureau for letting me use their map, and this is a really nice map showing you how different counties are appraised. They're not all appraised or updated every year, and it's every 3 years for all these counties in Ohio, all of our counties in Ohio, and it's staggered. So you, for example, see the ones in green, the ones that are showing up in green in this map, they were reappraised or updated in 2025 that will impact property taxes in 2026, and so on. It's a 3-year cycle. The variables that drove higher CAUV values and property taxes over the last several years were higher crop prices, lower interest rates, and higher crop yields that were in the formula. Most of these variables that are included in the formula are 7-year Olympic averages. So we're looking at the last 7 years of values that we have for these prices, interest rates, and yields. Yields are a little bit different, actually. And then we're throwing out the high and the low. So we're trying to find a way to smooth out some of these ups and downs, which haven't been real successful lately. There's been such extremes in some of these variables that are going into the formula that have really impacted CAUV values. Now, some of the things, the variables that are working in our favor now, if we're paying property taxes, is that we're seeing lower crop prices and higher interest rates entering this formula in the last couple of years and starting to show some impact. So here's the trend in this next table. We're showing you the ups and downs, and we saw some increases and some extremes here back in 2014. Slowly, those values fell, those average values for all the different soils in Ohio. This doesn't mean your soils are going to be valued at this, but the over 3,000 soils that they do track in Ohio, this is the average. Okay, reached a low point in 2020, and then some of the variables started to increase these values back up. What we have seen here, and counties that are going to be seeing property tax changes in 2026 based on these higher values in 2025 as compared to where they were in 2022. You can see, though, that we're seeing this starting to bend the other way. And that's what we're going to see is that in 2024, or I'm sorry, 2026, we're going to see those CAV values, average values, be even lower. So even though we're high as compared to where we were previously, we're seeing these start to trend downward. All right, there's some changes on woodland clearing costs that essentially have brought our woodlots down to the minimum value of CAUV. There's also a number of things going on, and one thing I failed to include in here that I thought I did is that there's new legislation that's being advanced by a couple of representatives that are looking to possibly make some minor changes to CAUV. One is to eliminate the annual renewal form. There's some other provisions in that tax legislation that's being introduced here just in the last few weeks. So that's one piece that also I don't include here, but we've got a lot of things going on in property tax, more so generally, and there's some provisions that have been passed that are going to impact us, but not specific to CAV or farmland. There are some resources out there, and now we shift gears into kind of the end of our session here. Let me pause a second and see if I've got any questions. Okay, so I agree that going back in history to deduct nutrient values is risky. How far back would you consider safe? Yes, we look at those tax years that are still available to us. So we're looking at that 3-year window essentially. So those tax returns that are still open to us once they're once they're closed by statute, we really can't go back any further than that. All right, let's see. I've got some things here. We're looking at issues, some questions that are falling in the chat. All right, so I'm not sure if anybody answered that. So we've got David. Did you already answer?
Yeah,
that one
we got that.
question?
We have
Okay.
that covered. Jeff and I do.
All right. And I'm not sure there, Natalie, what you're asking. Maybe that. Okay, that's just a follow-up. Okay. All right, so I think that answers those questions. Do any of you have any more before we start to wrap things up here? Okay, there are some resources out there. The Farmer's Tax Guide, which we recommend. There's actually a new one, 2025. That is available here recently. The ruraltax.org website, excellent resource that you may find interesting as well. A lot of good fact sheets and other things available there. Some upcoming programs. If you want a deeper dive into farm and agricultural related tax issues, we have an Ag and Natural Resource Tax Issues webinar coming up on December 15th. Now, this particular webinar is more targeted towards tax practitioners with continuing education credits available. However, if you're a farmer or someone with a farm that are doing their own taxes, this is also going to be a valuable webinar, and we encourage you to at least consider this one, and you can register there at that link. boy, I must have gotten the wrong particular slide set, because this one doesn't include some of the things that I had. So that is unfortunate. Let me see if I can find this here real quick. Boy. My apologies, folks. Here we go. All right. Let me see if this will work. Okay. How are we looking? Are we seeing upcoming events? Okay.
Yes.
Sorry about that again. We've got upcoming Farm Office Live webinars. The next one is December 12th. You can see and you can follow us through the winter as well. And I'll turn it over to David on this one.
Yeah, just know that our planning for the future of the farm workshops that Robert and I collaborate on are going to be held across the state again. The ones that we have in the near future are Clinton and Lorain County in December. You can see those dates there. Those are going to be multi-evening sessions. And then as we turn into the new year, Logan, Muskingum, Washington County on board. And know that we'll do an online workshop. So that's a live Zoom like we have here. That'll be the Monday evenings of March 6 to 8. So we know that's a few months off, but wanted to get it on your radar if you wanted that. And also know that we have an online Scarlet Canvas course, so you can take the course anytime, anywhere, any place that you want to. You can do it all from the comfort of your home. And there's a lot of material, more material than we have in our in-person or our Zoom workshops. And so that's why the cost is $149 per person. You can go on there. It's if you just go to go.osu.edu/farm succession, you can access all those workshops. So hope to see some of you at those workshops. And then Barry, I'll just continue our last coffee and grain and marketing with Dr. Sing-Ki Lee. You can see November 14th. Well, that would have been this morning, right? But the WASDE report is set to be released. It's not yet. I'm watching the WASDE, the NAS website, but that's going to be released here at noon. So what we did was pushed his coffee and grain marketing, kind of unpacking that report to November 21st. So next Friday. Just let you know that's next Friday, and Sing-Ki will be talking about the WASDE report. Going to probably be a lot of cool information coming out in the WASDE reports.
I'll just throw in here, we've got a colleague, Eric Rieker. I think he was with us earlier, but not. He's leading this effort, the Ohio State Organic Grains Conference coming up January 7th and 8th. So if you have an interest in that particular area, it's not too late to register for that. And there's a lot of great speakers and information that will be presented at that conference, I know. Any others? Sorry, folks. That is all that I've got. David, Robert, Jeff, anything else to add to upcoming meetings? Okay. We have an evaluation that is available, and it's available at this website. Also, I think you will be provided a link as you exit the webinar today. We value your input, so please give us that, give us some feedback, if you will. And again, our next webinar is coming up December 12th. And again, it's going to be 10 to noon. If you're already registered, you're going to get the reminder for that particular webinar coming up a week out, and then also a day out. So we look forward to having you with us in December. I want to thank all the co-presenters here online here, David, Robert, Jeff. Excellent material, and we hope that you've gotten something and enjoyed this particular version of Farm Office Live, and we can't wait to see you in December. Take care.